Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, April 2nd, 2020. I want to do a quick update on some of the things I'm watching today, trade ideas, including the broad market. We'll start there as I usually do if I'm going to cover the markets there up front, and then I'll cover a couple of the other trade ideas that both we're in now and other things I'm watching, official and unofficial trade ideas. All right, so SPY, I had a question posted this morning, these trading ranges. You can see just beautiful example of technical analysis. And my reply to somebody that asked, hey, Randy, we broke down, but then we went back up. Is that a sell signal? Well, I said, no. I talk about this quite often. When trading on a particular time frame, in this case, I've been using the 30-minute charts, all that matters is how you get the closing candlesticks. Now, you can take those early signals, but when you break down, because sometimes you just melt down on through there, and I'm talking about the trading range here. Let me flip back on the after hours and pre-market trades here. But what I'm talking about is waiting for a closing candlestick on the time frame you're trading. In other words, if it's a daily chart, then you look for a daily close, because it's very common to see these, intra-period whipsaws, false breakouts, especially in a volatile market. So, so my reply to that question: here's that trading range on SPY. We locked in same levels that have been on this chart now for at least a week, if not weeks here. 250, 50-ish, that's a big level to the upside, and then 244.93. So what happened today is right after the open, there was some selling at the open, but it was very brief. We're talking minutes, and it snapped right back up, printed a close. You can see these lines have not been modified. That line goes back to March 24th. And there's that candlestick close right above it. And then, so that's how technical analysis works. It's just a whipsaw signal. We didn't have a confirmed sell signal with the 60-minute close, and then boom, right back to the top of the range. So as I'm doing this video, I can tell you TA 101, this is an objective time to short. Just to digress for a second, I turned on the news last night. My wife and I, we don't usually sit and watch the whole hour-long segment, but we watch the evening news, and I must be in a different planet than the rest of the world. From what I've seen, going on with more and more shutdowns, this virus out of control, nurses overwhelmed, that kind of good stuff, or not good stuff. But so, anyways, from a fundamental perspective, yeah, I'm going to stay short. This is just what I think is going on here. What's technically induced, as I talked about. I'm not going to cry sour milk. We're still fine on all our short trades. But what I think this is, I suspect we are seeing, actually I don't suspect, I know we're seeing the heaviest, most aggressive intervention by the federal government in the history of the world. They said that, what Powell's done, what the Fed has done, already far exceeds what they did at this point early on the financial crisis. In other words, he's coming in harder and more heavy than before, and so you're going to see this kind of stuff. You're going to see these levels, as banks, brokerage firms, are the trading desks have been given money, free money by the Fed, in a directive, I have no doubt, to gun the market and support it at all costs. So, however, you might say, oh, well, Randy, why fight the Fed? Just go with it. No, I believe that, again, and I'm not going to say all the money in the world, because the Fed can technically print that, but there's just too much money trapped in the market, in hedge funds, pension plans, individual investors. And so look, maybe the fundamentals change. We come out, there's a lot of drugs in clinical trials right now, a lot of different things that treat this. Factories are being revamped to increase mass. So like I said, sometimes, and it usually is, it's always darkest before it's dawn. So maybe there's something coming out, and we have an explosive short covering rally. You have to be careful. But as of now, that hasn't happened. And I can't trade around thinking of what may happen. The best thing I can do is first and foremost let the charts be my guide, but also keep an eye on the fundamentals, because right now, a major fundamental catalyst, such as, again, something that drug combination, I talked about this before, vaccines at least a year away, so we've all accepted that. That's what I think every just about everybody's all the smart people that know about that kind of stuff are seem firm on that all the money in the world can't get a vaccine out in under a year. However, there's you don't have to have a vaccine. A cure would be even better, something, a treatment, even if it's just an abatement of the virus, some kind of something along the lines like Tamiflu that helps really stop it in its tracks, prevent the shedding of the virus, and all that good stuff. So we'll see. Again, as of now, let's keep it very simple. We're in a bearish a trend, at least according to the 60-minute or 30-minute trend indicator, the PPO signal line. It is above zero. Still has yet to cross over. We had a sell signal here, and we're locked in this trading range, and we're at resistance. So it's TA 101. You want to trade actively. If they pop it and can get a 60-minute close or 30-minute close, you can see two attempts here. That one was just a quirky after-hours trade. Let me turn off these after-hour trades, and then we'll move on. I want to get to some other trade ideas because, again, this is just one of many things out there. But that's it. Simple stuff. There's that pop and close back on that level, give or take, and so now we go lower, I believe, and then the next sell signal will come if and when we take out 244.93 with conviction, especially a solid red close. And in this market, the thing is, it's technical analysis is working so well, you'll usually see it. We can pull this trend line here, right here. Let's say that trend line, sometimes these trend lines drift. There it is. So when you get a breakdown and it's cleared all, then you usually see that big red candle like that. And then you hit, support, gap down to the next support. So, like I said, these levels are working almost too easy right now. But that's what I've talked about many times. I've traded through many bull and bear markets, and technical analysis really shines in times like this where nobody, the smartest of the smart, Warren Buffett, nobody out there can grasp, and give a, accurate prediction on any company's outlook, or most companies in the market especially, with using fundamental analysis, because this is a very fluid, extremely fluid and dynamic, rapidly changing situation here, country to country. A few weeks back, it was China's problem. Now it's the U.S.'s problem, and in some other European country. I don't mean to sound egocentric here with being in the U.S., but point is that and next week it may be a flare up somewhere else in another country. And so again, the fundamentals are shifting rapidly, and the technicals will be our best guide. And let's not overthink it. If they pop this level, yeah, sure, there's a gap to be backfilled. Whether it happens or not, I don't think so, with the trend being down. Just like yesterday, I mentioned getting into the gaps in those levels on the futures, and I shared my thoughts that I didn't think you'd get a backfill. I think they would sell into that breakout early, and that's what happened, and I suspect that here. So, active traders, there's your levels. Trade as you want. Swing traders, right now, I don't see any reason to cover shorts, and if anything else, I think it's an objective level to add. Let's leave it at that. All right, and then QQQ. Similar story, except we had what, on the Qs looked like a confirmed breakdown, little 60-minute close there. Or actually, no, where are we at today? Yeah, here's today. Close below that level, but remember, don't trade QQQ in a vacuum. Don't trade SPY in a vacuum. Look at them both. If you want to follow the Dow as well, great. It's another large cap index, but I like to watch these two. And and you need to see both of them break support, because if one breaks support and the other grabs support at the same time, and the buyers step in there like they did on SPY today, well, guess what's going to happen? These different indexes, but they have mostly the same top holdings. All those FANG stocks, or 4 or 5 of them, are all in the in SPY that are in QQQ, or if not all of them. And that's it. And same story. QQQ bounced back up. I told you it was trading between T1 and T2 with a little whipsaw below T2 today, and there it is, right back up to T1. Former support should now act as resistance, which it has. And that's an objective shorting op. Trend indicator still bearish. All right, let's move on and talk about some other places to make money. All right, gold. Let's go there first. Okay, earlier this morning I posted gold. Remember, a couple weeks back, I had a trend line, not a couple weeks, earlier this week, I should say, and maybe late last week, I posted this downtrend line saying next buy signal will come on that, and then we did, boom, popped above it today, 1634. I said that opens the door for a rally up to at least the 1634 area and quite possibly much more, and then we hit it shortly after. So, you almost have to have these levels in advance, and that's why I do these videos. You have to mark the trend line, set your alerts, watch them, and boom. So we'll probably get a pullback. Let's see, I haven't even looked at gold since. I reversed there for a quick pullback trade, because I think we'll get a pullback. There it is so far, and you can see again another example of technical analysis. You can't make this stuff up. There's the that you saw the post before it happened. There's the high right there, 1634.50 versus my line at, these don't snap to the nearest round number, or increment that they trade in. So that's close enough right there, plus a little momentum fueled overshoot. And there's the pullback right there. So, but most importantly, it's a breakout. So again, if you're an active trader, you don't need to, you can try to game the quick pullback and then get back in, and keep it very simple. That now means the next, however much the pullback goes, whether it comes all the way back down to 1616 or the trend line, or that's it already. Maybe that's it for the reaction. It's going to depend on what the dollar does. I'm going to give you that in a second. But look at that level. It's a beautiful level at 1634. Hence the reason, I put good odds, good enough odds to reverse it, take quick profits, go back to short, and then get back long again. But it's a big level right there. A lot of levels, a lot of reactions on there. So what does that mean? Well, if we pop it with conviction, big green candle, especially a solid 60-minute close through there, that could spark the next leg up on gold. That's an active trade right now. GLD, the ETF. Remember, futures are never official trades because I know a lot of traders out there, retail traders, don't have a futures account or the capital or experience to trade them. But there's another level there. I'll give you a couple more for you GC traders. So pop above 1634. There's going to be a little hiccup here, most likely, or at least minor resistance, whether we get a reaction there or not. About 1652 right there, and then 1673. But again, I think we may be opening the door for the next leg up in gold. So I just wanted to give you guys an update on that. And now where gold goes will likely but not exclusively depend on the dollar. I've talked about this many times in the past, whereas if you go back 20 years or more and put a chart of the US dollar and gold, you will see an unmistakable inverse correlation, meaning one goes up, the other goes down. However, when you zoom down to shorter time frames, periods lasting sometimes months, 6 months or more, there can be disconnects where both the dollar and gold can go up at the same time, or both the dollar and gold can fall at the same time. So like I said, it's, and if that's confusing to you, wishy-washy, how do you trade it? Well, for a trend trade, if you can make a longer term solid bearish case on the dollar, and sometimes just even short term, sometimes they're trading very closely, that inverse relationship, and other times they're not, and the same thing with crude and oil. But I like to, my point is, I like to keep an eye on the dollar, and here's what's going on with the US dollar. These are dollar futures. DX is the ticker symbol. Very good level right there. It just popped, but so far it's not following through on the breakout. That's about the 100.0112 level on dollar futures. You can see lots of reactions on that level. Lots of reactions there. Had a little triangle pattern at pop too. If it can hold that breakout, that's pretty bullish. There's not really much resistance all the way up there, the 101.922 level. That's a pretty big move in dollar futures if it gets there. Not huge, but and it would net, all other things being equal, give a headwind. In other words, make it work against a gold trade. Whereas if we can fail here, if that proves to be a false breakout, and that would something to watch for here, and that will affect how I'll trade gold going forward. If we fail that breakout of the 100-ish level there, and then especially come back in, fail a back test of these, here's the triangle apex right here, fall back below both those trend lines, that's going to be bearish for dollar, and you can see the downside targets here. Again, that's DX dollar futures. So that's one to watch for gold. And again, we're right now swing trading gold. So this is all noise. If you are not an active trader, you're a swing or trend trader, and you're in that gold trade that we have, the long, this is all noise. In fact, bigger picture, you can see gold is still in a downtrend right here. Downtrend's not yet really in question. Probably won't be unless we take that out. So that's just kind of near-term stuff and stuff to watch. And then speaking of things that tend to move with the dollar, again, that's an on-off relationship, but over the time it's tight. And for the same reason that gold, it tends to move inversely to the dollar, because both gold, at least the gold we're trading here in the U.S., gold futures, GC, GLD, the ETF, which is huge, those are priced in U.S. dollars, as is crude oil around the world. Crude oil is priced in dollars. So therefore, if the dollar drops, it takes more dollars to buy a barrel of crude or more dollars to buy an ounce of gold. Hence, that's why the price goes up. Again, that's all other things being equal. The other things being supply and demand forces, which can sometimes overwhelm, anything the dollar is doing. And so this is just the other day, March 30th. There was, gold setting up, and it was more of a question of when, not if, but when the next explosive short covering rally will begin. And so there's your buy signals, and then the downtrend line after the price resistance. There's a downtrend line. Here, you probably can't see it on the video. That's it. There's a downtrend line. Let's look at the live chart. That was from just a few days ago. And voila, boom, crude's up 22% today. There's your breakout right there, the trend line. It's been walking up this minor trend line. It took out that big 2191 level right there, and in just a single day here. Now it's up 22% as right now. This spike here, this surge was. I just moved my trend line there. Let me put that back. I had that level right there, somewhere around there. It's a limitation of this charting program. You have to you can't drag a trend line when you're next to one. They're all active. And I'm going to move that up there. So you're talking about a 28% pop in crude oil futures. That's, I don't know, probably 10 grand or more per contract. In such short order. But I just want to say that's what an explosive short covering rally looks like. Everybody's short and bearish crude, and it doesn't take much to trigger something like that. It was probably the inventory report is my guess there. I'm sure today's Thursday. So, and then look right up to that 27.59 level. That level's been on the chart for a while too. Okay, now let's talk sugar. Sugar's looking sweet. That pun never gets old. Here we go. Sugar. These are sugar futures. This is from the official trade I just posted. If you're listening to this video, you probably should have received the email notification on that trade. 10:40 Eastern Time. Sugar futures pending a breakout above these trend lines. As you guys know, I call myself. I define my trading style as very anticipatory. Unlike conventional traders that wait for breakouts and breakdowns and buy and sell signals, sometimes I'll anticipate those and take it ahead of time. So I said, I thought it was, case could be made for an aggressive entry here in anticipation of what appears to be a likely and imminent breakout. You might ask, well, why do you do those? You look at, crude, for example. That rally was explosive. If you weren't in front of it because of the bullish technicals, you probably missed it. You probably missed an objective entry because it exploded, probably half or more of those gains came within milliseconds. High frequency traders, those are computers, not humans. They're machines that run. Yeah, they can get in front of that, but it's hard for you and I. So that was this morning, and then here's the levels. It's pretty clear. Well, let's go to the live chart here. Just where is that chart? Got it down here somewhere. Here we go, and boom, there it is. And there's what I'm talking about, and that's why you sometimes need to get in front of these when you see what I define as it looks like an imminent and likely breakout. Boom, there's the pop shortly after I sent that post out today. It happened quick, and where did it stop? Not mere coincidence, right at the trend line. Boom, pulled back, and so there's a breakout. That's buy signal number one. As I said, buy signal number two now comes on a break of these intersecting resistance levels, that both the trend line and the 101.73, and then that should take us up here, something like that. And if you're wondering, what I see that makes it appear to be an imminent breakout, it's many things. Again, it's all in that post. It took a while to put together that post. I want to be, thorough, and that's a great example how I use multiple time frames to trade, whether it's swing trading or trend trading or even investing. The long-term charts paint the big picture. Let's go back to that post here. Sugar. So I posted, 3 different time frames on here. I posted a weekly chart going back for years, all the way into 2002, and showed you long-term support, showed you the same setup that we had before with those, was pointed out back at the time in August of 2018. We had fallen to a long-term support zone, which was an objective long entry. Your next long entry came on the breakout above the bullish falling wedge pattern, and from that point right there, it was a 55% rally. And this is wash, rinse, repeat stuff. In no way does it guarantee it'll work out, but this is trading 101. You take these shots, you make a pretty solid case, and you can see the preferred scenario has us going up from here because we're at support, but it can't rule out. This markets like to do this. They like to trick the masses. And sometimes you get a stop clearing move, and like I said, if it did, what separates that from a breakdown, it could keep going, but the way you trade that, if you, especially like I said on this trade, you can, a lot of ways to trade it. You can scale in. Scaling in means you start here now. If it starts to pan out, you continue to add. If it starts to go down, you continue to add. Either way, but you have a bracket. You don't keep adding down below much more. As long as it's just a minor reversal like that. And if we get that, great. That's a bear trap. That's even more powerful, stronger fuel for a rally. However, if you're waiting for that to happen, it doesn't happen. You may miss the boat, just like back here. Came close to that level there. So again, that's why I added it as an official trade. And we did the same thing with gold recently. That GLD long a couple weeks ago, added it at support where I could easily see the possibility that it would have kept going down and was in a strong downtrend after a divergent high. But because gold was in a bull market, I don't want to. I want to step in at the earlier levels, just like the dip buyers were buying the stock market for years at the early pullback targets. And that's the nature of a bull market. And so now here we can't really say a bull market in sugar. In fact, you just look at the bigger picture. And again, it doesn't, labels like this, they are important to align with the trend. But, we had a clear bull market here, and then we had a bear market here, but it's more so been a sideways market for years now. And again, bull or bear, doesn't matter. It's a 55% rally, so you can call that a bull market from here to here if you want. You can call this subsequent drops instead of bear market. But anyways, there's a case has been laid out, and again, that's how this one's like a lot of trades. And whether I always post all the different time frames or not, most trades will use multiple. I'll confirm entries and exits on multiple time frames. So SGG, that's our proxy for this. Proxies for official trades are always ETFs or ETNs, again, because a lot of traders don't have futures. Cane is another one. We'll look at that real quick for you here. Let's go to SGG is one. There it is. And look at that wonky little print. Look at that. Oh, gosh. If somebody must have bought that. I don't know if that's a legit print. I guess so. It's showing here. Look at that high at 37.02. I don't know if I'm going to count that as hitting the official target. Let's see what happened. Look at the. Actually, you know what? They did. They ran it up. It wasn't a single trade. Wow. I didn't even have time to set a price alert yet on that target. All right, guys. Well, T1's been hit. Kudos to you that took profits there. Again, that's the whole reason I list multiple targets. Is each target level is an area where reaction is likely on the initial tag. So that's our initial tag. And I'll tell you, in the pullback now, if you didn't even get the post till now, it's still an objective entry. And we already hit that target once. So next time we may go right on through it. So I'll have to update that trade as soon as possible. T1 has now been hit. And again, it wasn't an errant print, as I just showed you. You can see the trades. It was multiple trades here on the 1 minute chart. It did ramp up to that level legitimately. Sometimes in that, what I'm talking about is in the after hours and pre-market sessions, sometimes you'll see all the candlesticks trading around us, like QQQ and SPY, for example. They're super liquid, very big, and then you'll see one print way up here, and then you get those wonky little long skinny tails on the candle like that, or wicks at the top, with the candlestick body being down here, and those you kind of disregard. There means there may have been a trade at that level, but that's how things work in the after hour session. Someone might have had a input the wrong price on their order, and then somebody saw it and took advantage, because after hour and pre-market trades are always limit orders. So all right, anywho, back to the chart. So I'll have to calculate the gains and on that one. And again, it's still, and let me say this, if you enter it now, that's still, let's call it the first target. Again, we may have another reaction there once again. It's now been further validated because we've had, of course, yet another reaction off it. And then the other one, like I said, was Cane. Cane didn't have that kind of pop so far. Or did it? No, let's see. No, because where sugar was right here. Yeah, it was actually. What I'm looking at is sugar had, and I might have covered this in a video the other day, what a lot of eyes probably believed to be a big bear flag pattern that was going to project, to the measured target, which is a flagpole, the length of the initial move down. And again, in trading, sometimes I will I'll recognize something as bullish or bearish, but I may choose to dismiss it thinking it's not going to play out, and that was the case of that. So I just want to let you know I did see it. Now where I'm going with that is that's where that first target on SGG was set, right around just below the top of that, we'll call it a flag pattern. And then Kane actually hit that too. So you can see it was, oh no, Kane didn't. I'm sorry. That would be the comparable level. But see, Kane is a different ETF, ETN. You can see our previous trades over here, or unofficial. I usually use SGG. Might have used Kane that time. But the basis for that trade, and this one still is, and there's another proxy, is this right here, positive divergence, which is now actually, looks like it's might be confirmed with that. No, not yet. We haven't made a bullish cross on the PPO, but you certainly have the divergence there. And again, it was shown on all time frames. All right, let's move on. Okay, let me touch on PALL. I posted an update under the comments section on the yesterday. It was initially a trade set up pending with an entry pending a break below 207. Just shortly before the close, we broke below and closed below. So it is an actual an active trade now, and was as of just before the close yesterday. We went on and backfilled this gap right here today and bounced back. The market's bouncing, hence the reason palladium's bouncing. Palladium's going to be a play on the stock market really at this point going forward. I think it's going to be a play on economic growth expectations. The market rallies. Everybody thinks the worst of Corona's over. And if that's the case, people are going to start going out of their house again, walking back onto car dealerships and buying cars. And therefore, car dealers are going to turn back on the assembly plants, start making cars, and ordering palladium and platinum for their emissions controls. And as such, again, you're seeing this is when the stock market plunged. Here's when the stock market rallied recently, and you can see kind of trading, pretty much in lockstep with the market today. All right, so that's that. But from a technical perspective, so what happened? First, we hit the gap. I'm referring to this gap right here, gap backfill, bounce. But we're below, most importantly, we're below there. We're at 310.77. I wanted to give a little margin of safety there. So we're below resistance. I think it looks good. PPO is down, turning back down below the zero line there. I like that. All in all, I like the trade. We just need the market to take its next leg down, which I think is coming soon here. And then Palladium futures. One of the things that did happen, that's why I shared this chart, because that's what PALL is trying to track here. You have the secondary trend line. So we had the first trend line here, and then that 216 level, I said that needed to go. And so that did go yesterday. Let's zoom in. We're flirting with it right now. It's pretty much a back test. So we zoom in tight, and these were the most important near-term levels, both the uptrend line, like I said, this one here off that low, and right there, and the 216-ish level, and we're right there now. So we had a little dip below, so you can call that a successful recovery, but we're not well above it. This could be a back test. The optimal scenario right now will be a rejection here soon off Palladium futures, and then go on to break that trend line, and that should open the door for the next leg down. What's not going to help us if we snap back above and successfully hold this level. If we do, the trade is certainly not written off at any point. There's big resistance here. That's where if we do bounce, we have the back test. There's two levels to watch on the Palladium futures. You have the ascending broadening wedge pattern. That's probably one of the most important things on this entire chart. We broke down, it was impulsive. We came in, we made a back test, and so far we failed on every attempt so far underneath the bottom of the ascending broadening wedge, meaning this trend line. And then just above that, you have a very well-defined or pretty well-defined resistance at 23.92. So let me just say no bueno for the PA short. If we get above that level, fine as long as we stay below, and all the better if we can now start to move impulsively lower, which I suspect we will along with the stock market here soon. All right, we'll wrap it up there. That's it's a lot of stuff. Like I said, this is I'm a big believer in both diversifying, whether it's just within your trading, active trading, as well as investing, and within diversification, asset allocation. And that's again how, in my opinion, to most successfully navigate the next bear market or the current one that we're in now, because it's going to be very hard. You can diversify and try to sniff out and buy the most bullish stocks, but just like all ships are lifted in a rising tide, meaning most stocks will go up in a bull market, most ships fall in a falling tide. And so you're really swimming against a tide trying to pick out dividend paying stocks, blue chip stocks, especially if we get another impulsive wave of selling. I've been through enough bear markets and corrections to tell you that the babies get thrown out in the bath with the bath water and those kind of drops. And so the easy thing to do, much easier than trying to pick the stocks that look the best in bear market. Again, there might be some exceptions there, some stocks that have hardly any correlation or no correlation or inclusion into the large indexes like the S&P 500 or the Russell 2000. Those are okay at times, and those that fly under the radar or have a completely unique business model, in which case they're clearly going to profit, with whatever's going on at the time. So we'll look at those, but again, then back to what I was saying, commodities, palladium or gold tends to go up often in during corrections and bear markets. Not always, but depends on the technicals. If the technicals are confirming it, which they do now, and the fundamental case for it. And then you have other commodities, like I said, sugar. People aren't going to stop putting sugar in their coffee, no matter how bad things get with Corona. In fact, more people staying at home, probably drinking more coffee right now. So we'll look at that too. KC, Coffee, and Joe. I'll take a look at that in another video. All right, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.